Welcome back to Alpha Recap. Today we're breaking down a market tape that felt like 3 or 4 different markets running at once. Markets closed mixed, with tech doing a lot of the heavy lifting while crypto really took a hit. As always, if you have questions, you can reach us at stockalpha.ai. More on that at the end.
Great to be here. There was a lot to unpack. AI-driven strength in technology, real project-backed financing in materials and real estate, and then a pretty sharp repricing in crypto. It wasn't a single macro story. It was a collection of idiosyncratic catalysts.
Okay, let's start with the obvious, technology. You heard a lot about the agent race today, OpenAI, Anthropic, and that seemed to drive a broad group of names. Walk us through why investors piled in.
What changed was that the agent narrative moved from theory to product. When large players started showing agent builds and enterprise proofs of concept, the spending shifted from research budgets to procurement budgets. That means more cloud compute, more demand for inference accelerators, the chips that do real-time model work, and more spend on data pipelines and monitoring tools. For investors, the takeaway was, own the parts of the stack that will actually get recurring revenue as companies deploy agents at scale.
So it wasn't just the headline names rallying, but the whole infrastructure chain. Cloud providers, middleware, specialized semiconductors?
Exactly. The rally looked structural in places. Cloud compute and enterprise AI tooling were rewarded because they stand to capture ongoing spend. Pure play consumer AI plays without enterprise traction were getting treated more skeptically.
Switching gears to materials, there was that big $1 billion backing for the Goon Gary Nickel Hub. That sounded concrete. Why did markets like that?
Capital commitments matter. Nickel is a key battery input for electric vehicles, and a big committed round, about $1 billion Australian dollars in this case, materially lowers project execution risk and shortens timelines. That made nickel juniors and battery cathode names look less speculative because the project had a visible path to production, offtake, or at least clearer sponsorship.
So the difference was financed, contract-backed upside versus just hope?
Right. Today's winners tended to be backed by signed deals, loans, or explicit financing. That's why materials and parts of real estate outperformed, while anything reliant on pure liquidity, like crypto, suffered.
Speaking of crypto, Bitcoin slipped under $64,000 and we saw spot ETF outflows of about $545 million. That's a big day. What happened and why did miner stress matter?
A wave of ETF redemptions forced selling across the ecosystem. When spot ETF holders redeemed, custodians and market makers had to find liquidity, and that pushed the price down. On top of that, some miners were reportedly trading below production cost, which raises the risk of forced asset sales or margin-related liquidations. The combination amplified the downside and raised the risk premium for crypto-adjacent equities.
Practical question. For someone holding crypto exposure or mining stocks, what did today suggest they should do?
Caution and selectivity. Trim outright long exposure if you're uncomfortable with further liquidity-driven declines. Consider hedges, options, or inverse instruments for crypto-linked equities, and watch daily ETF flows and minor balance sheet headlines before adding back in. Until flows stabilized, the path of least regret was to reduce asymmetric downside risk.
Energy felt bifurcated. Oil eased after some diplomatic progress on Iran, but traders were still buying specific barrels and there was a continued push on renewables and storage financing. How should investors think about that?
Energy split into two very different stories. Traditional oil and gas is still driven by geopolitics and near-term supply risk, so it reacted to easing tensions and softened. Meanwhile, the transition side, renewables, grid-scale storage, kept moving because of large financing deals. Those storage financing packages reduce execution risk and accelerate capacity additions, which is a multi-year story distinct from commodity swings.
You mentioned storage financing. Numbers I saw were about 3 billion euros from the European Investment Bank and about $1.5 billion in storage finance. That's sizable.
Yes, those are big-ticket facilities. They change project economics and timelines. When development capital is in place, projects reach commercial operation dates sooner, which creates predictable cash flows for developers and utilities. That's why investors rewarded those names.
Real estate also got a nod today. Big construction loans and multifamily deal flow. REITs reported solid results too. Was this a broad vote of confidence for income assets?
To an extent, the market was rewarding asset-backed income-generating opportunities where underwriting was clear. Large construction financing for an office conversion or signed multifamily transactions are examples where future cash flow is contractible. That's attractive in a market where rates remain a wild card.
Communications and towers felt more mixed. Crown Castle and shifts at big carriers like Verizon got called out. What was the issue there?
Tower operators face both cyclical demand and long-duration leasing risk. If anchor tenants change their capital allocation or if anchor leasing slows, that creates uncertainty for valuation models that rely on long-term leases. For carriers, consumer shakeups or retooling of networks can create winners and losers across the supply chain. Investors reacted to those pieces of execution and structural risk today.
All right, let's pull all that into practical moves. If you were advising a portfolio manager for the near term, what actionable insights did today's tape produce?
A few clear themes. 1. Favor financed, contract-backed growth over speculative liquidity plays. 2. Be selective in technology. Focus on AI infrastructure rather than hype-only names. 3. Reduce or hedge outright crypto exposure until ETF flows stabilize. 4. Separate commodity bets from transition investments in energy. Treat them differently. 5. Use policy wins, like cannabis ballot momentum or electrification financing, as signal windows for targeted exposure. And 6. For income investors, prioritize real assets with clear cash flows, like multifamily or industrial REITs with visible lease roll characteristics.
That's a lot to act on. What are the main risks that could upend this view in the next few weeks?
Key risks include a surprise move in interest rates or a rapid shift in Fed commentary, which would pressure REITs and long-duration tech. Continued crypto ETF outflows or a minor capital crisis could spread to equities and credit. Geopolitical flare-ups would quickly flip oil's narrative. And finally, any escalation in AI regulation or data policy could slow enterprise adoption and re-rate parts of the tech rally.
Any bellwethers listeners should watch in the next month or so?
Yes, daily ETF flows into and out of crypto. Incremental revenue commentary from large cloud providers tied to AI or agent workloads. Offtake announcements and construction starts for nickel and battery material projects, REIT earnings and occupancy trends, and storage project commercial operation dates and procurement announcements from utilities. Those will help confirm whether today's splits were the start of broader trends or just episodic noise.
Before we wrap, give me 3 crisp takeaways for listeners to remember from today.
1. Markets closed mixed. The winners were often those with signed contracts and committed financing. 2. AI strength was real, and it's pushing money into infrastructure, not just consumer-facing models. 3. Crypto moved down on liquidity, not fundamentals, so manage position sizes and watch flows before getting aggressive.
Great. That's a clear framework to work from. Thanks for walking through all of that. Quick reminder, if you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. We'll see you next time after the market close.